Unlocking the timing in trading, why, when matters. So in this video, we're really going to dive into the when and why the when is important. So why should we care about when? Why should we care about timing in trading? What good is it for us? What are the benefits? And how what does this look like? So in this video, I'm really going to focus only on the theory. There's only 3 short slides I'm going to go through, and then we're going to dive into some drawings in TradingView. We're not going to dive into price action yet. We're going to leave that for future videos. So in future videos, we're going to actually use the theory that we're going to cover in this video and dive into actual price action and see how it applies into the real trading world, so to say. But for now, let's dive into the most important question: why should we care about timing in trading? What I always say is that I find time is often the forgotten child in trading. So time is a very often overlooked element in trading. You don't hear people talk about it a lot, in my opinion. There's a couple of things like FIB times, which are not often covered. Harmonics incorporate time, which are more advanced, obviously. But other than that, you don't really hear a lot about time being used in trading, because most courses teach you where to trade, but not when to trade, right? It's always about, in some way or the other, finding a support or resistance level. That could be simple, like high time frame bar, or horizontals like daily levels, weekly levels. Then it could be way more complicated, stuff like Elliott wave theory, which also incorporates a bit of time, I guess. But you know what I'm getting at. Some way or the other, you usually learn where to trade, not when to trade. But what if you knew not only where to trade, but also when to trade? Just this question alone should trigger, for me at least, trigger, well, because this is the question I started wondering at some point, what if I knew not only where to trade, but also when to trade? And for me, it was like, well, that would be really powerful. And I'm going to explain how I come up with that question in a bit when we dive into some drawings. But the question for here is now, what are we doing with finding support and resistance level? And the basic principle, we're identifying patterns, right? We're identifying patterns in price action. So in order to do this, identifying when it happens, the only thing we need to wonder is, are there patterns in time, just like there are patterns in price locations? And here it's already answered. Yes, there are. There are patterns in time, price delivery, when price is delivered, just like there are patterns in price location. And that is pretty much the whole basic principle, what this is built on, or at least it was as you will see in the data, that there is patterns in time, and that's what we're using here. So before we dive into the chart itself, I just want to give you a quick overview of what actually the benefits are of mastering the time. And I'm going to cover all of these in the next videos. There's a lot to go through, but I just wanted to give you a heads up of what actually are we going to look at and how is this going to help you before I dive into everything. But I promise we're going to cover it. But for now, let's have an overview. First of all, it can help you enter a trade with more confidence. So this is what I'm saying. Imagine you have location and now you also have time that makes sense. So the location makes sense. You have a resistance, and then also you have time that makes sense. Will give you more confidence to trade. It can help you stay out of a trade when it's low probability time to enter a trade. So if you see that something reaches your resistance but doesn't actually have a good time, it helps you stay out. And again, we're going to cover this in way more detail. Determine the most likely direction of price action. Distinguish a scalp from a day or a swing trade. Determine take profit targets. Determine invalidation points. Identify trade setups based on high probability pivots. And that's actually the last one. But these are the main benefits I've seen now in the last nearing up to a year or so of using these time statistics into my trading, and also with members within Minome Analytics. These are the main benefits that we've been able to take out of using time into our trading. Now we're going to take a little bit look at how it does that. And I'm sure you're all aware of it. We had for a long while a very volatile moment during FOMC minutes. When the FOMC minutes came out, we had massive volatility, right? So we knew that when price hit this moment, we knew there was going to be volatility. We didn't know where. we just know something was going to happen. So at the start of the day, we came here and we were like, all right, so this is where we are, right? Price went like this, open the day. And here we're kind of ranging and we know, well, there is something going to happen here. So we'll wait and see until price gets there. So what we always, what we always did at least a lot is not really enter any trades here because we knew, well, something's going to happen there and it's quite risky. It's going to wait for a price to go here and then it's going to give us the answer of what's going to happen. So all we had to do at that time, or at least what I noticed, is that my best trades were always during these FOMC minutes or any other high volatility news event. Now, why was that? Now, let's say we have a horizontal resistance here. I'm just going to mark those out in white. Resistance and support here. So as we're trading, we just wait and to see where price goes. But I noticed that my most powerful trades were always during this. Why was that? Because what often happens, so price progressed during the day, and what then happened, for example, is that we had this slow grind into this resistance level that I was looking at, and then on the moment the news came out, you often had this like final push, and then bam, this massive rejection going up, down to the other way, or the other direction, right? The reversal. So I almost always, when there was still high volatility during these events, because it doesn't happen a lot anymore, it doesn't happen anymore, but back then it was always very volatile. Almost always I nailed these trades because I was waiting for this, and because I knew that we were running into a very big resistance. Not only did I have the place, right? So this is the place, resistance. I also knew the time that something would be likely to happen. Now, if we were leaving a lot of liquidity here, so this is just liquidity, and then we, push up during that exact time where I knew something was going to happen, then it was way more likely that you're going to go down and take all that liquidity. So at some point I started wondering, well, because, what I did was just enter here, stop loss above the high, and they were almost always really great trades. So what I started wondering, well, what if we can do this all the time? What if there is a way of always knowing, or at least on not being reliant on just FOMC minutes, which happened once a month, but pretty much always knowing when a certain pivot was most likely going to happen. Because all this is a pivot, right? It's the highest pivot of the day. And that's how I started implementing, or at least gathering statistics for time. And I found out that, yes, there are patterns in time. And we're going to dive into that way more in the next videos. We're going to see the patterns. But for now, I just want to focus on the theory of, why does this help us? Why does this help? So we've already seen one example now because it gave us the time and the place, right? So in this case, the first thing I mentioned, enter a trade with more confidence. This would give me a lot more confidence to enter the trade because I knew the place and the time, right? I knew it was time for something to happen. So a lot more confidence. Let's look at some more examples. So say we're here, price. Say we have here resistance and we have a resistance here. Let's say we don't have time, right? We don't have time to our disposal. And we go here and we see we reach that level. And then this is where we're like, all right, we reached our level. I think I'm going to enter a trade because I see some reaction. Let's suppose we see a reaction and I'm going to target these lows, right? These lows. Now, then what could happen is that we retrace and you're like, well, my trade's going my way. So I'm going to stay into my trade. But what happens then is that price goes back up, stops you out, and then finally has the real move to right here. I personally often had this where I was really good at seeing the reaction and then I got in, but then I always was too greedy with my take profits. Then I eventually get stopped out and then the real move happened and then usually I missed that real move. Now time can help you with this. let's reenact this and say now this time we have time. And how we use time is the following. Say we come here and then we look at statistics, because in the end, this is just statistics, right? It's just statistics. There's no real hocus pocus or anything. It's just plain statistics. Say we have right here a certain time, and we know this is a low probability time to put in a pivot. And then here, we have a high probability to put in a high. Let's say a high. I'm going to talk a bit more about pivots later. Low probability time to put in a high, and a high probability time to put in a high. So in this case, what happens is if I reach that, I see, well, I now have the place, right? Because this is my resistance. This is an actual resistance. I've identified this as a resistance in my system, but it doesn't have confluence with my time right now. If I look at historical data, I see that historically speaking, this is a very low probability time to put in a high during the day. Right? So now I know that even though we have the time, or even though we have the place, we do not have the time for it. So I can do a couple of things. I can either decide to stay out. So where at first I decide to enter a trade, I am not going to enter a trade. I'm not going to enter a trade. Why? Because the timing doesn't make sense. So what happens then is I stay the trade, it retracts a little bit, and then price goes here. So same example. And I know this is all theoretical, but we'll go into, like I said, we're going into the practical examples later. And now I see the high probability time matches the place. So now I can say, well, I'm going to dive into this trade, whatever your take profit targets are. I'm going to dive into this trade, and there you go. Price goes into your direction. So, and I know this is all, again, this is hypothetical. It's easy for me to draw it like this, but I'm just trying to explain the concept. We're going to go into the practical examples later and how it actually manifests into the price action. But as you can see here, in this case, it helps you stay out of trade because you have two resistance close to one another. This is an example that really happens a lot in trading. One of them didn't have time as confluence, the other one did have time as confluence. So it allowed you to stay out, which is the second benefit. But another one here is this one here, distinguish a scalp from a day or swing trade. Because you could decide to enter here still. It depends on what kind of trader you are. But say you are a scalper, right? Say you're scalping, there's resistance and you see the reaction you want to see. But you know, in this case, well, it's not a high probability time to put in the high for the day. There's probably going to be a higher point later on in the day. You know you're going to be aggressive with your take profits. So that's another point here. Determine take profit targets, right? It helps you. And there's other ways to, I just want to say there's too many examples to actually go over in this short theory. I just want to give you the basic principle of it. There's other ways to have take profits. There's multiple ways of determining scalp from a day or a swing, as we will see in the future videos. But now I just want to give the basic idea. But this will help you to take profits earlier, right? It'll help you to take profits earlier because you recognize, well, the high is going to probably be later in the day. Even if we do get a reaction, probably we're going to have a short reaction rather than a long reaction. So not a day trade or a swing trade, but a scalp is more likely, and then we're going to go higher. So for me, one of the problems I always had is, well, I've had, my entries were really good, but it was just that I had very much difficulty with determining if something was going to be a scalp trade, a day trade, or a swing trade. Like, how big was the move going to be? And then I found these times, and I've gotten, it can help you become way better at it because of these reasons. So that is how it can help you stay out of a trade, have more confidence to enter a trade, determine the nature of the trade, right? Whether it's a scalp, day trade, swing trade. And again, these are just some examples. I'm just trying to make the concepts clear before we dive into how we actually use it. And you will see that there's actually patterns to this in later videos. And then, just give one final example. If we, for example, have price action unfolding like this, and we have here a low probability time to put in or yeah, a low probability time to put in the high. And right here we have a high probability time to put in the low. So in terms of time, high probability low, and this is a high probability or low probability, I'm sorry guys, high, low probability high. So we have the low was put in during a very high probability time zone, and the high was put in during a low probability time zone. So we have, a low that was put in during a high probability time for a low, and a high that was put in for a low probability during a high. Now, how does this help us? Say we retrace all the way to here. And this happens, as we will see as well, this actually happens quite a bit. Then what we know is we have a high probability low and a low probability high. So what we can say is that, well, this seems that it's high probability to be taken out today, and this has a higher probability of holding. So how does it help? Well, it helps us determine direction, right? Determine the most likely direction, and it helps us identify trade setups, invalidation points, and take profits. And even this, right? This is an example, a really good example how everything goes at once. Actually, it helps you with all of these points, and I'll show you how. So if you know this, then you can say, well, whatever your method is for determining entries and exits, again, use your TA in Confluence. Then you can say, well, I'm going to enter a trade here, or let's say here. And my invalidation is here, because I know this is a high probability low based on times, and this is a low probability high based on time. So my invalidation is here. Even if we just wick through it, then my idea that this was a high probability low doesn't make sense. Or at least it's invalidated, right? So my invalidation is there. And I know that this has a high probability of being taken out today, so I can target at least this. So in this case, just with one thing, I've identified the trade setup, or just with the element of time, we can identify the trade setup, determine the invalidation point, which is right here, because we know this is a high probability low, determine the take profit targets, right here, and wherever, you can, like I said, use more than just this, use TA. Distinguish the scalp from day swing trade, because in this case we know, well, this is going to be a day, at least an intraday trade. And determine the most likely direction of PA, because we know that this low is likely to hold, this high is unlikely to hold. So we know that going up makes more sense. So I know there was a lot of theoretical mumble jumble, and you might think right now, all right, well, that's easy to say at this point. I want to see it. So that's exactly what I'm going to do. But first, I really wanted to explain to you the concepts of why timing is important to trading. The main thing is this: if you not only know where to trade, but also when to trade, that's very powerful in terms of confluence. It will help you, gain that confidence to enter a trade or to stay out of a trade and do the things we talked about. But I hope it's clear that combining the where and the when is important, and there are patterns in time delivery, price delivery in terms of time, and we're going to dive into that next. But I hope for now, at least, that it's clear why timing is important in trading and how it can help us in, into executing trades or defining and spotting good trades. So I'll see you in the next video.